Good afternoon.
Sorry, David, you just muted.
Good afternoon. I'm David Mandy, President of O&M Partners, and I want to welcome you today to the Nomad Royalty Group's Town Hall call. Nomad trades under the symbols NSRXF on the OTCQX, and they also have a symbol on the TSX, NSR. The questions and Q&A are for everyone. They can be easily answered by going to the question portal of GoToWebinar or by emailing us. Any questions that remain unanswered will follow up in a timely manner after the call. For those who dialed in with your phone, the only way you can hear the pre-recorded introductory presentation is on your computer speakers. If that's not possible, you'll be able to hear the main presentation after about 5 minutes. So please stay tuned. Before we turn to our host, it's a pleasure to introduce our introductory speaker today, Paul Harris, editor of the Mining Journal. Paul has been a mining sector researcher, analyst, and reporter. He has over 16 years of experience in this sector. He also founded and edits the Columbia Gold Letter that focuses on gold and copper sectors. Paul received his BA in Business Administration in University of West England, UK. He's also has an MA in International Relations for the University of Chile, Santiago, Chile. So on that note, I'd like to turn the call over to Paul.
Hello. Gold continues to maintain a floor at about $1,700 per ounce, which sees producers continue to build their cash reserves, pay down debt, and pay dividend, as evidenced by the year-end results coming out this past earnings season. Royalty and streaming companies continue to benefit from the prevailing relatively high prices and prove their robust earning potential even during times of difficulty, such as the COVID-19 pandemic the past year, due to the diversification of their portfolios, which provides a natural hedge against the ups and downs of the performance of any single individual asset. Now, with the base metal sector showing increasing signs of life and higher prices, many streaming and royalty companies are pursuing opportunities to add to their portfolios as base metal miners seek to capitalize on the precious metals byproducts contained within their deposits. The streaming and royalty space will also benefit as the next wave of mergers and acquisitions breaks, as this will move the assets royalties are held on closer towards production. Recent months have seen transactions start to occur with producers looking to consolidate key land packages near their existing operations or acquiring assets that will become part of their future development pipeline. Transactions in recent months have tended to be in areas where companies already operate and where they were able to undertake due diligence visits within the travel restrictions imposed in response to the COVID-19 pandemic. Thus, we have seen transactions in Ontario, Quebec, British Columbia in Canada, and in Nevada in the United States, for example. We're also seeing an increase in strategic investments whereby a company buys a notable, although non-controlling stake in another company, which is often viewed as a down payment on an eventual takeout transaction, assuming the main project of interest continues to develop positively. What is perhaps of most interest to those watching the junior mining space is that recent transactions have shown that premiums are increasing. That is, buyers or strategic investors are paying above and sometimes well above the current share price of the companies they are targeting. This can suggest many things: that the competition for assets is increasing, that companies are seeking to lock in deals which will have strategic benefits or synergies with their existing assets, and that the project pipelines of some companies are not as meaningful as they need to be in order to sustain the business going forward. While the deployment of COVID-19 vaccines is picking up around the world, there is an expectation that travel will gradually become easier later this year, and with that, the ability of corporate teams to go out and undertake due diligence on assets that interest them will increase and improve. As this happens, there is an expectation that M&A activity is only going to increase as the year progresses. Royalty and streaming companies can benefit from growing M&A activity because they may already have agreements in place on assets that are subject to such transactions, but also because they are a source of finance which an acquirer may seek to tap as they seek to structure a deal. Many companies are still wary of taking on new debt, and so streaming and royalty financing can be an attractive option as it does not add debt to a company's balance sheet. And also, the buying and selling of exploration properties often includes the creation of new royalties, which the holder may then seek to monetize ahead of time by selling them on to a royalty company. So the opportunities for royalty and streaming companies are far from exhausted.
Thank you, Paul Harris. Paul, again, is the editor of the Mining Journal. It's now a pleasure to turn to our host, Joseph de la Plante. Joseph is the founder, chief investment officer, and director of Nomad. Joseph has has a deep background in the mining industry. He's been an executive with public company experience in all aspects of mine development. Prior to his current role, Joseph played a key role in the creation of Osisko Gold Royalties as vice president of corporate development. Prior to this, he was with Osisko Mining Corp through the development, operation, and subsequent sale, $4.3 billion sale of Canadian Malartic mine in 2014 to Yamana, Gold and Agnico Eagle. Prior to his executive roles, he advised resource clients in both mergers and acquisitions and financing at BMO Capital Markets. So on that note, it's a pleasure to turn the call over to Joseph.
Thanks very much, David. I'm just sharing my presentation here. There you go. It's an absolute pleasure to be here presenting today with the O&M group. We've been presenting a couple times now and have enjoyed the expertise of David and his team to share our story with different groups of investors across the US. For those of you who don't know Nomad, we are a new precious metals royalty and streaming company. We listed in May of last year, and we are essentially one of the newest entrants into a sector that's been around for almost 10 years now. The royalty model is a really great model and a great way to invest in gold. Contrary to operators or development companies, we don't own projects outright. Royalty companies, rather, we have a portfolio of royalties and streams. So it's contractual agreements with mines across the world that give us the right to receive physical metal directly into our accounts. And we trade this metal, and that's how we generate our revenues. And so we are companies that can achieve a great scale with a very small, nimble team. And it's what makes this model so powerful. It's very scalable. We can offer a huge amount of diversification and fundamentally generate a significant amount of free cash flow and redistribute some of that free cash flow to a high dividend. Nomad is it is the highest dividend yield currently in the precious metal space, and also gives us still lots of free cash flow left over to continue and reinvest into our business and grow the portfolio. So it's a great model. I had the pleasure of starting this company early last year with two of my other partners, Vincent Metcalf and Elif Levesque. The three of us are the founders of the company. We've come back into the royalty space, having spent the last 8 years building up another precious metals royalty company, Osisko Gold Royalties. So we're a team that knows what we're doing in this space. We're hitting the ground running. And as shareholders of Nomad, you're benefiting from all of that expertise in this new vehicle. So on that note, I will jump into the presentation. Maybe just before going through the full presentation, a few key points to understand about what we're doing. So number one, when you invest in a precious metals royalty company, you're essentially investing into a team. Obviously, there's a portfolio and assets within our business, but really where royalty companies generate value for their shareholders is how we continue to grow the business over time by making new acquisitions. And the team is really the key driver in that growth. So when you buy into Nomad, you're getting a team that's done everything that you can think of in the royalty space, from M&A transactions, big ones and small ones, buying portfolios, structuring project financing streams and royalties. We've really done it all. So there's no learning curve for us, and you're getting all of that to the benefit of your investment. Secondly, this is really a ground floor opportunity. New listings in the royalty space are not that frequent, certainly not listings of the size that we're coming to the market with. Rather, it's an occurrence that happens every 3-4 years, or even 5 years. And so the opportunities to invest in the first year in a royalty company don't come around that often. And when you look at the history of the royalty companies, how they trade, almost 10 times out of 10, there's significant share price growth as the companies build out their businesses and grow, just because of how powerful the model is. So this is truly a ground floor opportunity and really a good time to be looking at investing in a royalty company. Thirdly, we're 100% precious metals. And that is a really key aspect when you're investing in a royalty company, because there are many different types of royalty businesses, fundamentally the same, but the strategies vary in the sense that some companies have pursued other metals. Some companies have decided to buy assets like mines outright. We are 100% pure play. We do not own any mines, and we invest only in gold and silver. So very important. Also, we're starting out of the gate with a very high level of cash flow. And cash flow is one of the key ingredients that you need to be successful in the royalty business. It's important because it's the way that we crystallize value when the commodity prices go up. But also, it's what allows us to borrow to continue to fund new acquisitions. So the cash flow aspect of a royalty company is very important. We're building Nomad to be a free cash flow machine, and we're building the portfolio by thinking about bringing assets into the portfolio that are coming online in the near to medium term as opposed to the long term. So very important cash flow aspect to our business. And finally, the valuation right now is very attractive. When you compare Nomad to our peers, for businesses that, for a business that is as mature as any other of the intermediate royalty companies out there, we are trading at a discount. And so it's a really good time to be looking at Nomad right now. From a capitalization point of view, we're about a $550 million Canadian market cap. We are listed on the QX exchange under the ticker symbol NSRXF. We trade primarily on the TSX under the ticker symbol NSR. We will be looking at a full US listing over the course of the year or early next year. It is within our plans. It's not something that we did out of the gate, just being a new business and the costs that come with being a dual listed company. But when you look across the royalty space, it's evident that having the dual listing with a Canadian and a US listing is something that's done tremendously well for the companies and their share price. And therefore, it is something that is on our box of things to check over the next 12-18 months. From a balance sheet point of view, we have $25 million of cash. Currently, we have an undrawn $75 million credit facility, which gives us in total just over $100 million in financial capacity to deploy into new opportunities. And this is really important. We are currently looking to grow the portfolio, and that is how royalty companies deliver value to their shareholders, by making new accretive acquisitions. We have all the firepower that we need right now to deploy into new opportunities. We're highly involved in many different opportunities of all types, and Paul in the introduction was mentioning the strength of the royalty model, which is that you can cater to many types of financing situations that are out there, be it helping gold mines finance the construction of a new mine, or base metal producers refinance that. We can be involved in many types of situations, and with our financial capacity right now, we're highly confident that we will be able to deploy that capital over the course of 2021. Our dividend policy is very strong. It's something that we wanted to lead with out of the gate. So Nomad paid a dividend in the first quarter following our listing. We've paid 2 dividends so far. We're yielding about 2%, actually over 2% today. It's a 2-cent dividend paid quarterly. And at this rate, we are about double the average in the precious metals royalty space. And this is something that we want to maintain over time. As our portfolio continues to grow, as assets within our portfolio continue to come online, we are going to grow this dividend and grow the payout ratio, because we truly think that the royalty model has the benefit of being able to service a high dividend and also continue to fund growth. And that's why you do see this great value accretion over time as a shareholder. It's because you're investing in a yield company, but also in a growth company at the same time. From a research coverage point of view, we've done well over our first 8 months, getting the research coverage up to 9 analysts right now. Our average target price is over $2, all by recommendations from all of the analysts that cover Nomad. So if you have any interest in reading those research reports, please reach out to myself or to David, and we'd be happy to share these research reports with any prospective investors or current investors. Here's a couple numbers that demonstrate where we stand right now and also how simple our business is. So we are in US dollars, $450 million market cap. We reported just about a month ago our first full year of operations, just under $30 million of revenue. 86% of that was profit margin. And that comes back to the fact that we are not an operating company. We have our assets are contracts. We receive precious metals directly from different mines across the world. And what's important to understand is when we make our investments to buy these royalties or fund these streams, we have a capital commitment on day one when we close the transaction, but we have no further investment to make thereafter. And our contracts are for the life of mine of these operations. And so what that means is that once we make our investment, all of the revenue coming in is pure free cash flow. And that's why we're able to have a profit margin that's so high. And it's why we're able to run this business with just 6 employees. So with the 3 founders, on top of that, we have 3 additional employees. We have no need to grow the team as we make further acquisitions. So it's a very lean platform, very scalable, and can offer a huge amount of diversification for a precious metals investment, much higher than what you would find elsewhere through other types of investments in the precious metals industry. We have 6 assets that are cash flowing currently, 14 in total in the portfolio. Some of those are planned to come online this year, some over the next couple of years. And what's important to understand about how we are growing our portfolio is we're not just buying assets to show that the number of royalties in our portfolio is increasing. That is really not what we're looking for. Every single asset that we have in our portfolio is a royalty or a stream on ground that is owned by the operator of the mine. We don't invest in royalties that are owned by juniors around existing mines. We have royalties on assets that truly there's work being done. There's an incentive to bring these properties into production, and there's a path for these assets to come into production. So every single asset in the portfolio is thought out, and we're not just accumulating royalties for the sake of accumulating royalties. Here's the 3 founders of Nomad, myself and my 2 partners. The 3 of us have been working together for the past 8 years directly, but all of us have been working together much longer than that. In the case of myself and Alif, going back to our days at Osisko Mining, operating an existing mine, and Vincent Metcalf and I started our careers together in investment banking. So we're a team that know each other very well. We've been through difficult situations together, and we've done many types of transactions together. So we're not, we don't have to learn any new skills to start this business. Everything that we're doing, we've done before. And that is really important in this type of business, especially when you're looking to execute quickly and execute a growth plan over a few years only. When you invest into a royalty company, it's important to understand the context of the industry. We like to think of the modern royalty business as having been around for essentially since 2007, since the re-IPO of Franco-Nevada. In that time, we've seen a huge amount of growth in the sector, and can be explained by a few different things. Obviously, the commodity price has helped, but we've also seen the model become a lot more prevalent and accepted by operators. it's rare now to see mines being built without some form of royalty or stream being now a part of the capital structure. And so that means there's more deal flow, more transactions to be done, and that explains the growth. What's quite interesting though is that, you know, when we look at the aggregate $60 billion of market cap in the precious metals royalty space today, still that is dominated by the top three players, Franco-Nevada, Wheaton Precious, and Royal Gold in terms of size. Each one of those businesses have become very large, to the point now that they need very large transactions to move the needle on their earnings. And so, you know, those companies are looking at deals that are 500 million plus, or else, you know, they're really kind of focusing on the wrong part of the business. And that's really opened up an opportunity for companies such as Nomad to come in and focus on that $50 to $200 million deal range, which is much more impactful to us. There are more of them, frankly, because there are more assets in that, you know, in the smaller size range being built. And it really is a big opportunity. And it's a conversation that we have with a lot of our investors, you know, is the royalty space too crowded? Because we have seen a lot of new listings over the course of the past year or 2 years. Our view is no. Actually, within our specific size range, we are one of the few players within that range. If you look currently outside of the top three, the number of royalty companies that can write a sizable cash check, it's really can be counted on one hand. And really, there's only a couple of them, and we are one of them. So we think that we're best positioned to capture this opportunity. And we're certainly seeing that right now in the deal flow that we're involved with, that there is an opportunity for Nomad to execute on one or many sizable transactions as we continue to grow our business over this year and next year. I mentioned the fact that we're a new company and that we listed in May of last year. We've been very active in terms of setting up our company. So in 2020, we completed the listing. We put in place our $75 million credit facility with a syndicate of Canadian banks, which is fully undrawn as of today. We have 9 analysts covering Nomad. We paid our first 2 dividends, and we've made 4 acquisitions. That was in 2020. And the way we think about it is last year was a year of heavy lifting, setting up the business, making sure that we were ready and best positioned to compete in the space, so that this year, 2021, we're just focused on executing the growth strategy. And really, you know, this comes down to deploying on a big streaming transaction. That's our key focus right now, to demonstrate a couple things. One, that you know, our thesis is correct and that opportunity exists, which we're highly confident it does, but also that our company is best positioned within this space to do exactly that. We have the financial capacity, we have the skill set, and the opportunities are plentiful. And once we do one of these transactions, we think that it'll prove our thesis of coming into the royalty space with this specific vehicle at this point in time. A quick note on our portfolio and how we think about growing the portfolio. So as you can see from this map, we have assets located across the world, and it highlights an important part of our strategy that we're really focused on, which is diversification. So we like assets across the world. Obviously, we're staying away from high-risk jurisdictions, but we do believe that royalty companies can offer something that operators can't, which is a high amount of diversification for our investors. And the way we think about our portfolio is no different really than most equity investors think about their portfolio, which is we're staying away from value concentration. We're not looking for big cornerstone assets. We're not looking to be overexposed to one single jurisdiction, because in the mining business, the good jurisdictions, the same as the more difficult jurisdictions, they go through challenging times. And if you're overexposed to one area in your portfolio, your entire portfolio is going to get revalued until those issues are resolved. And it's really not a dynamic, number one, that we want. But secondly, we have the option as a royalty company to avoid that and have much less volatility within our cash flow. And that's really what we're trying to offer to our investors. It's a low risk way to invest in gold mines globally and get a high level of cash flow and a good dividend yield by making a precious metals investment. And it's, again, it's not something that you find with every precious metals investment out there. It's really unique to royalty companies. And I definitely think it is the reason why, if you're interested in investing in gold, you should definitely invest in at least one royalty company. It's I think, become an accepted part of every investment strategy in gold. Looking at the different portfolio metrics that we track, the key thing is the metal breakdown. As I mentioned in my intro, we're focused on precious metals. Right now, we're about 80-20 gold and silver. That split may change as we continue to make acquisitions and bring new assets into the portfolio, but we're going to stay dominantly gold. And the important thing is we're not going to go in oil and gas or bulk commodities or battery metals. Those are not commodities that belong in this portfolio. We're building our business to be a gold and silver business so that when our investors buy shares of Nomad, they know that that is their gold exposure in their portfolio, not these other commodities. Over time, what you may see is if we see a good royalty on a copper gold porphyry, that can have its place in our portfolio in a measured way. But really, we're maintaining that focus on precious metals. The other thing that we track and we think is really important is the percentage of your overall net asset value that comes from cash flowing assets. And the reason we think this is important is because if you look at the valuations across the royalty space, what you typically see is the three big companies get the highest multiples because they have over 75% of their portfolio that's producing. When you go into the intermediates, that percentage actually drops down drastically, and in some instances is less than 10%. We are very well positioned within that intermediate peer set right now at 40% of our portfolio that's producing. We do have 2 assets coming online this year. That's going to take that percentage up to about 75% by the end of the year. And so we're already standing out within the intermediate peer group on this key metric. By the end of the year, we're going to be closer to the seniors at about 75%. And it's the big reason why we think our company is unique across all of the other royalty companies in the junior and intermediate space right now. Our view is the highest multiples goes to cash flowing assets, and that's what we're focused on. We're focused on bringing cash flowing assets into the portfolio, whether they're producing right now or if they're producing over the next 12 or 24 months or 36 months. Having that near-term visibility on cash flow is the key, and it's what we're focused on. Within the portfolio, we do have some assets that are very high quality and we think ultimately can be company makers. One of them is a royalty on the Robertson Deposit. This is a royalty we acquired last year through the acquisition of Coral Gold. Robertson is a very key part of ground that forms part of the Cortez complex. Cortez is arguably one of the best gold mines in the world. It's owned by Nevada Gold Mine, which is a joint venture between Barrick and Newmont. It's been producing for a very long time, and Robertson is essentially coming in to be the source of new ore feed within the next 5 years. And this joint venture, Nevada Gold Mines, has announced that Robertson will essentially become a very, very major contributor to the overall Cortez operation within the next 5 years. So we acquired this royalty in a very timely manner. The interesting thing is that there's mineralization sitting on surface, which is what they are currently thinking of in terms of the near-term development. But in parallel to that, they're also conducting some deeper exploration to look for the typical deposits that we find within the Cortez camp, closer to Gold Strike and Gold Rush and 4 Mile. And so we think there's a very good chance that one of these deposits is hosted on this property. Barrick has said so themselves in their last press release, where they state specifically that there's a chance for a major discovery on this property and the corridor between Pipeline and Robertson. So it's rare to find a royalty like this in the royalty space that has near-term production potential, but also a significant amount of exploration and potential for major discoveries. And so we're very happy to have this one in the portfolio, and we think that it's going to be a very exciting royalty to own over the next couple of years. The other royalty, or stream, I should say, that we have is a stream on Blackboard in South Africa. Blackboard is a a very high quality major gold mine that produced over 45 million ounces in its history. It's being restarted with a very significant mineral inventory remaining over 20 million ounces. It's commissioning as we speak, so we will begin receiving ounces from Blyvoor over the next couple of months, and this operation will ramp up and begin producing over the course of 2021. But an asset of this size and quality is really unique in the royalty space. So between Robertson and Blyvoor, two, essentially potential tier 1 assets that we have already in the portfolio, and as we continue to make acquisitions, the bar is pretty high in terms of these royalties that we have in the portfolio today. When we look at acquiring assets, we're also looking, it's not the key part of our strategy, but we're also looking to make smaller investments in deposits in good jurisdictions that we think have a huge amount of potential to deliver outsized returns. Over the course of the last year, we've made 3 acquisitions that fall within this category. One is on the Blackboard deposit in BC, the other on Troilus in Quebec, 2 big gold deposits being advanced by good teams where there's a near-term potential for production over the next 3-4 years and a significant amount of exploration that's still happening. And these are the types of royalties that you buy them and 2 years later, you realize they've doubled in value because the operators have done so much work on the deposits. So very happy to have picked these up. We also acquired a royalty on the Moss Mine in Arizona owned by Northern Vertex. A very good royalty to bring into the portfolio. Essentially, this is a small heap leach operation in Arizona where the operator has been so focused on putting the mine into production over the last couple of years. Now that they're starting to generate free cash flow at these commodity prices, they're taking all of that money and reinvesting into exploration and adding value to the royalty that we already own. So we were very happy to pick this one up last year. And generally, we're looking for deals in the size of $50 to $100 million, but these are the types of royalties that when you find them, you buy them because they can add a lot of value very quickly in your portfolio. The valuation portrait is an important one when you're looking at Nomad right now. The left-hand chart here shows the price to NAV multiples in the royalty space currently. On the left-hand side, you see the top 3 major companies, Franco, Royal, and Wheaton. These are the big companies in our sector. They're the ones that trade at the highest multiples, and essentially the businesses that everyone is trying to emulate in the space. The middle box shows the intermediate peer set, and within this category, we'd say Mavericks is our closest peer, MMX. They're currently trading at 1.5 times. When you compare ourselves to Mavericks, we are very similar in a lot of ways. We actually have a higher percentage of our net asset value that's currently producing. And so we think that there's a very strong potential for a near-term re-rating to these levels. We're trading at 1 times NAV right now. There's no reason that we should be trading at a discount to our peers. And importantly, as I mentioned through the presentation, as the year goes by and as our 2 assets come online, bringing our percentage of assets in production to 75%, we think that we could be trading at the top end of that intermediate peer set or even in line with the seniors, because that's essentially the key metric that we've seen deliver those higher multiples over time. And the interesting thing is, as you invest today, you do get that 2% dividend yield. On the right-hand side of the page, you see how that compares to our peers. So we are the highest dividend yield currently in the precious metals and royalty space. So in conclusion, it's a very strong business model, very simple business. We can do a lot with a very small team. And we are, as I said, all the heavy lifting is done. We have a very mature and solid platform, and we're focused on execution. And the important thing with our team is we're all large shareholders. Myself and Vincent Metcalf, we're the 2 largest shareholders of the company outside of our 2 large sponsors. And so everything that we do, we're thinking like owners. We're actually not taking a cash salary for the first 12 months of operation to demonstrate that to our shareholders, because every decision that we make, we're making it for the interest of our shareholders and to make sure that the share price goes up. We've also been buying shares in the market. We do think that this is a really good opportunity to invest. And so I would urge you to look at Nomad. There's, in our view, the sky's the limit this year in terms of where we could trade at. We are fundamentally undervalued, and so it would be great to have new shareholders come into the market and join us on, as we continue to build out the business. So on that note, David, Scott, perhaps we can end the formal presentation and we can turn it over to Q&A.
Thank you, Joseph. Very well done. We're going to start with Bruce Daigle. Bruce, do you have questions today for Joseph? Just going to unmute you.
Matter of fact, I was typing it in right now. Can you hear me?
We can hear you, Bruce.
Thank you, Joseph, for this update. Can you just discuss a little more about your, Orion and Yamana and what their plans are for the longer term?
Absolutely. So Nomad was created by a reverse takeover transaction where Vincent and myself essentially acquired two separate portfolios, one from Orion, one from Yamana, and those assets formed the starter portfolio for Nomad as we listed. And Orion and Yamana became shareholders of Nomad by taking shares for those assets through the listing. And so they are both the largest shareholders today. They're, how we essentially brought them into this company is they were, they had these portfolios of assets on both sides, and we're considering what to do with them. And what we essentially laid out is a strategy by which, we would take these assets, start a company, continue to grow the portfolio by making new acquisitions, dilute them down over time to more normal ownership levels, and get that multiple that royalty companies typically trade at. And that's the idea that we pitched them on when we started the company. Both groups are highly astute investors. Obviously, in the case of Orion being the largest mining private equity firm out there right now, but as well in the case of Yamana, who've smartly invested in their own operations, but also smartly divested assets and shown that they can be patient and get those higher valuations over time. So we expect both groups to be highly patient investors. In the case of Orion, I can certainly say that they are thinking of Nomad as a very key part of their strategy, of their long-term strategy. This investment is a long-term investment for them. They're essentially looking at the royalty space and saying, okay, well, we've seen Franco list and go from $11 to over 200. How do we recreate that and own 10% of it? So long-term position for them. They're a great partner. They feed us lots of transactions. They're essentially a second corporate development team. So we expect them to be fully aligned with us as we continue to grow the business. Yamana is a little bit of a different portrait. They're a public company. Their royalty portfolio was a non-core asset for them. They've demonstrated an ability over time, as they did with their Brazilian mines, to divest smartly. In that case, they formed Brio through a series of M&A transactions. Those assets have ended up with Equinox, and many, many years later, they exited their shares of Equinox. So I would expect the same in a sense with Nomad. The thing is that, we're a new company. We have a fairly tightly held float, and our expectation is that we will be the ones going to them and saying, we have new investors that want to come into the stock. Would you free up some shares to generate liquidity and bring in your investors? So both groups are fully aligned with us, and we do expect them. They're on our board. They're part of everything that we're doing. They're highly supportive. So they're moving in lockstep with us as we're growing the business.
Thank you. That was awesome. Second question, and this will be my last one. I've heard recently that lots of producers are also trying to get into the streaming business. Is this true? And is it going to help shine light on the group, or be more competitive?
Producers, as in mine owners of mines, are looking to get into the streaming business,
or looking to provide financing. I meant like you would.
Well, I can't say that it's specifically something that I've come across in any of the transactions that I've worked on recently. I think it's obviously an interesting time in the royalty space, and over the past 5 years, we've seen many types of new financial groups come in and be active. I think the royalties and streams are strategic in a sense, because when you invest in a capital structure through a royalty or stream, you're now a permanent investor in the asset. So I can certainly see some logic of operators wanting to own these assets, as perhaps a way of getting involved in an operation. The challenge being that the valuations typically don't work for operators because they trade at much lower valuations than the royalty companies do. And so it takes away some of that edge that you have in these financing processes. But it would be interesting to see, if that were to materialize, how it would play out. I can certainly say that over the years, we've had discussions with operators around these types of arrangements where we could work with them on co-investments or things of that nature. It's always been an idea that's been considered, but never really executed on, I'd say.
Thank you. Very good answer. That's it for me. Appreciate the update.
Thank you.
Thanks for your questions, as always, Bruce. We'll turn to Chesley Morton. Chesley?
Cute. How about that? So in addition to your investment and your purchase of an NSR, after due diligence, does Nomad or its principals ever take an equity interest in the companies, target companies as well?
No, we don't. And there's a key thing that we look for when we're investing in an operation. So what we look to deliver to our shareholders is a fundamental return on an underwritten understanding of what the mine is when we invest in it. And then beyond that, we're looking to deliver optionality that historically materializes into significant wins for the royalty holders. So it's sort of a dual nature that we're trying to get in our investments, that bond-like return, but also that equity-like upside. And the equity is challenging from that point of view, because it's obviously there's potential for returns, but you have the downside, because the markets are volatile. So we haven't done it so far in Nomad. With previous experience, I can say that it's something that I understand well, but we're not looking to do it, at least not in a big way, in Nomad. Would we ever use that as an incentive, maybe to write a very small equity check to help facilitate a transaction? I think it could be done, but you should expect that we'd never be long-term shareholders in any business that we take equity in.
Gotcha. With regard to your investments in the smaller companies, I know you've got some large cap partners as well, but in the small cap companies, is there a covenant that prevents them from, say, taking on a loan from a loan-to-own predator that would jeopardize your interest?
The answer is yes. So, and I'll maybe make one key differentiation. There are different types of deals that we can look at in the space. Some of them involve buying existing royalties that were written 30, 40 years ago and are still kicking around, and you buy those contracts today. And the other type of deal that we look at are deals where we originate new royalties and streams. So if I take the latter, the origination of new transactions, I can say certainly without a doubt, the contracts that we write ensure a couple different things, but one important one is the longevity of the assets that we're creating. So in the case of royalties, it means that we're registering them on title. Often the case that we get security, similar to how a bank takes security over your home when you borrow from them. We take security on either the mining titles, or in some instances, even some corporate assets of the companies that we lend to. And it protects, fundamentally what we're trying to do is make sure that these royalties and streams follow the asset, because they may change hands, they may go through good and bad times, but we're ensuring the longevity. And there's many ways to do that, and you can ensure that we're using all of them in all the contracts that we create ourselves. In the case of legacy royalties and ones that have been around for a while and were written at a very different time, there are still ways to protect yourself. Those contracts are not as strong. However, in the case of royalties, you can do things like register them on title in most jurisdictions, which provides a certain level of confidence. But it's the main reason why, as a royalty company, you want to be doing both. You want to be obviously buying good royalties that you can come across every now and then, but you want to be originating your own assets, because what you're buying is a contract. And if your contract is a good quality contract with all the modern protections in it, it's worth more. And as a business, you end up building a much more solid portfolio if you have that ability to originate new royalties and streams. And it's an area that our team has a lot of expertise. We've done many transactions originating new royalties and streams, and it's why it's become a focus for us. On top of being involved in many types of other types of transactions. But as an investor, I can certainly say, when I invest in a royalty company, I look at the team, and some of them have the skill set to do these new streams and royalties, and others don't. And the resulting quality of the assets is reflected by that. So it's an important question.
Yeah, thank you very much, and a great presentation.
Thank you.
Thanks, Desley, for being on the call. We're going to turn to Heinz Thoma, please. Heinz, question today for Joseph.
Joseph, can you hear me?
Yes.
You can indeed, Heinz.
Okay, great presentation. You mentioned before that you are trying to get a listing in the US, a full listing, possibly this year or next year. Your share count is fairly high, and I could imagine for a full listing in the US, would you possibly have to do a reverse split?
So it's something that we're contemplating, and we've been discussing this openly with our shareholders. As a matter of fact, at our last AGM, we did approve a share consolidation. We likely will be approving another consolidation at the next AGM. We're conscious of the fact that we have a high share count. What's important to understand is that we have a higher share count, not as the result of many years of issuing shares, but rather because of how we listed our business.
Understood.
Yes. So we are looking at one, and it would be done. I can't give you the specific timing, but for sure, it'll have an interplay with a U.S. listing, and it'll either be done in conjunction or in conjunction with another piece of news.
Another question, with a concentration of your shares in relatively few institutions, would you consider having maybe Orion issue or give up about 10, 15, 20% of their holding in order to increase the liquidity?
Yeah, it's an important consideration. We did do late last year a secondary offering of a portion of Yamana's shares for this exact reason. There was some demand in the market from some institutions, and so there was a $25 million secondary offering. It resulted in 8 new institutions coming into the stock. The secondary aspect is always going to be there, and it's going to be an option for us to go see them and knock on their door and see if they'd be willing to distribute some of their shares. I think from the case of Orion, as an example, when we did the Yamana secondary, they did have a piggyback option and had the opportunity to participate in that offering. They declined. So they are thinking about this position as a longer term position, and we would rather I think dilute them down by making new acquisitions and refinancing perhaps some debt a couple months or a year after we've taken it on to make an acquisition. And the key thing to understand is right now we don't need capital to grow. We have $100 million of cash available to us. We don't need to go out and do an offering. We can fund any acquisition that we're looking at. We can fund it 100% with our credit facility. So there's no need for a share issuance today. But what you've typically seen with royalty companies is they can fund acquisitions using their debt. And once the market's understood these assets and you've seen the benefit of these assets for a couple quarters of reporting, perhaps some refinancing at higher equity valuations. So it's always something that we're considering. And yeah, that aspect of distributing a portion of our shareholders' shares is a possibility, but it's not something that we're looking at anytime soon.
Thank you very much.
Thank you.
Thanks very much, as always, Heinz. We'll turn now to Murray Vanderveld on the line with us. Murray, any questions today? I know you came on a little late. Yeah, you're unmuted, Murray. Just give it a second, please. Scott, if you have questions from the group, let's go to them, and then we can come back to Murray if he has a question.
And I will
Please.
say too, Murray, if for some reason you're having trouble with audio, you can always chat in your question and we can ask it for you live. But we do have some from the audience, including another one from Bruce, and that is, what is your dividend payout ratio today versus your long-term target?
So we're paying about 30% of our operating cash flow right now. And that's a very comfortable level just because of how our business is structured. We have a high component of our portfolio that's producing right now. So we think that as you know, we have Blackboard that's coming online this year. We have Woodlawn coming online near the end of the year. Those will allow us to grow the dividend. And again, just going back to my comments around what a royalty business is, we're a small team that receives a very high level of cash flow from our assets. And if we stick to the strategy of cash flow and a high component of our NAV from cash flowing assets, it means that we have a lot of capital to allocate between the dividend and the growth. And so we can achieve our growth objectives, but we can also pay one of the healthiest dividends in the space. And, you know, we're shareholders first, right? So we love the dividend. You know, both Vincent and I are very happy when every quarter we get our dividend checks. So we would be open to the idea of growing that dividend ratio over time. I think we want to let the assets mature in the market and let the market get confidence around the deliveries. But there's nothing preventing us from increasing that payout ratio. I won't commit to a number today, but we're definitely looking at that over the next couple of years.
Thank you. Next question comes from Eric Lemieux. Salute, Joseph. Excelente presentation. That's my attempt at that. Was the Robertson royalty acquisition based in part to personalized relationship buildup?
Yeah, so I think I understand what he's trying to get at there. So one of the questions we get asked a lot is how is Nomad competing? Obviously, there's a lot of other players in the space, and we all are looking at our own deal pipelines. Sometimes the processes are competitive, sometimes they're not. And what's important for investors to understand is that the personal relationship that a management team can have with sellers of assets is very important, and often is what determines the difference between success and failure on a transaction. Robertson was an example where we were able to move quickly, where we had a privileged relationship with the sellers, and even though they had received other cash offers or different types of offers from other public royalty companies, they chose Nomad as a partner because they understood our vision. They saw a team of people that wanted to think differently and be bold in the royalty space and have big aggressive growth plans in terms of what we want Nomad to become over the next 3-5 years. And they understood that their royalty was valuable and could be a key part of that strategy. And so they wanted this asset to go into the right vehicle so that it could, one and one could make three, and the resulting company could be that much stronger, and they themselves would benefit, through their share ownership, because a big component of that transaction was a share component. And so it's an example where that personal relationship that we're able to build, the speed of execution, all of that mattered in the end, coming down to how we were able to bring that over across the finish line.
Thank you. And you mentioned competition. This is a good follow-up question for that. There are so many precious metal royalty companies which are competing for new acquisitions. How do you avoid the temptation to overpaying in order to get bigger? So many royalty teams seem to concentrate on showing increase in gold received.
Yeah. So I'd say that the key thing that we did, because it's a dynamic that we're well aware of, and when we were looking to start Nomad, we had different opportunities in front of us of how to go into the royalty space. And the reason we liked the portfolio required from Orion and the one required from Yamana, is it allowed us to list with a scale and with a level of cash flow that we thought positioned us differently in this sector. We could have come in with other assets that would have made us a $20 million market cap coming into the fold, or a $50 million market cap. From experience, we know that's hard. And when you don't have cash flow, we know it's hard to find capital to grow. And so a lot of, we had lots of questions about how you're going to compete, what are your competitive advantage. A lot of those questions were answered by how we started the company and the scale that we chose to launch with. And I truly think that we have the perfect size right now. And we have cash flow, so we can borrow. We have a credit facility. We have everything that we need to execute on this growth plan. We don't need to go to the market. We have the deal flow and the connections and the network and the expertise to either buy existing royalties or structure new streams as part of complex project financings. We've done all of that. So all of the ingredients are in place, and that's how you mitigate that risk. That's how you compete, is by setting up your business properly. And once that's done, things are a lot easier after, when you're going in and you're sitting in front of an operator or a seller of a royalty saying, well, I don't want a term sheet that says you need to raise money. So we think that we've done everything that we can, and we're at the perfect space at the perfect time. And truthfully, I think that we will execute on a lot of transactions over the next 24 months.
Thank you very much. The next question is, what are the Excise prices of your warrants and stock options?
So the warrants, there were two series, essentially in around the same time. The strike price is, one is $1.71, the other is $1.75. Those are held by counterparties with whom we did transactions to acquire royalties. The options are all held by employees. So there's a couple of different series ranging, I think the lowest ones are at 20 cents and ranging all the way up, I think, to $1.30, with some at 90 cents, but they're all employee options.
Thank you. And the final question I have from the audience is, there are some who believe that we will eventually experience a period of hyperinflation. Does your business require commodity prices to advance in lockstep with interest rates?
Well, I mean, I think the fundamental thesis here is, for gold at least, is that hedge against inflation. And so, yeah, I mean, the royalty companies are nice because you're investing in operations across the world in a way that you can invest through many different cycles, right? As opposed to investing in an operator where you're trying to time your investment with, the operation, but also the macro environment, trying to time your entry as a function of the gold price. Royalty companies, we exist through all types of macro environments. We deploy capital when gold price is strong, when the gold price is weak, when the copper price is strong, when the copper price is weak. There's always an opportunity. there's like a 12-cylinder engine. It's always something going on, and it's why we can be so active. And it's really what explains the success of royalty companies. It's that ability to deploy capital constantly in all types of environments. And so a royalty company is very different from an operator from that point of view, where that's a little more about timing the commodity price and hoping you get lucky on the operation, or that you're backing a good team that knows what they're doing on the operations. The royalty companies are a very different type of investment, much longer term, but with a strong potential for very good returns over those long term.
Good answer. Thank you so much.
Does that conclude the question, Scott?
It does, yes. If anybody
Okay.
has any other questions, please email them to us and we'll be sure to get them answered for you and get them back.
Wonderful. Well done. Back to you, Joseph, for closing remarks.
Excellent. Well, thanks very much, everyone, for listening in and for the thoughtful questions. We're very happy about where our business is positioned right now in the space. We think there's a huge opportunity in the royalty space right now to create that next big royalty company, and we're best positioned to capture it. We're thinking like owners, we're big shareholders, and so you can rest assured that when you invest in Nomad, we're incentivized the same way as you are as an investor. And fundamentally, we have everything that we need to execute on this plan. And so it's a great time to invest. We'd be happy to discuss individually with any shareholder that wants more information about the strategy, about the assets. I've put our contact information here on this page. You can also reach out directly through O&M, or you can go on our website. There's a button on our front page that gives you access to a tool where you can book a meeting, a time slot with myself or with Vincent Metcalf. We're always happy to talk to shareholders and to give you more information about our business. So on that note, thanks very much for dialing in, and hope to speak to you soon.
Thank you very much for presenting, Joseph, and I want to thank everyone for your attendance today. Greatly appreciated. I wish you a pleasant evening. Thanks so much.
Thank you.